Okay, the cost variances are prepared. These cost variances are also, now we see the cost variances are prepared for the elements of cost, like we have the material variances, then we have the labor variances, and then overhead variances. These overhead variances are again subclassified as the variable overhead and the fixed overhead. So that is what we have. So now the questions what we have in the examination kit are about the overhead variances. So the first one is variable, then we have the fixed overhead variance. What is a fixed cost? What is a fixed cost? My question is simple. What is fixed cost? What happened?
Ma'am, fixed cost is actually the cost does not depend on the number of units, and it is fixed.
That's right. That's as simple as that. It remains fixed. It does not vary with the output. That is a fixed cost. What is a variable cost? Variable cost is a cost which varies proportionately with the overhead. What is an overhead cost?
Indirect cost.
Indirect cost. Indirect cost can be explained as which is not identified with the cost object. So now indirect costs are not identified with a specific cost object, but their nature could be variable or fixed. So that part we have to have a clarity. What are cost objects? Any entity with which cost can be identified as a cost object. It could be a product, it could be a service, it could be activity, department, unit, section, anything can be a cost object. So here, if we take production to be as a cost object, then we see that there are certain overheads which are not identified with that particular product. Okay, then some of them are identified with the product. If they are not identified, they are called as overhead. If they are identified, they are called as direct costs. That part is also fine. But these overheads are just not identified, but their nature could be, they could be variable or fixed. So if the standards are decided for variable overhead and fixed overhead, then we need to take up a variance analysis for variable overhead and for fixed overhead. Okay. So what variances should be calculated under variable overhead and fixed overhead? The other day also I mentioned to you that variable overheads will go on par with the material variances and labor variances. The way the material cost is split into the price and the usage. Price and usage are then further split into, they are calculated as to difference in the price applied at the actual activity, difference in the quantity applied at the standard rate. That's how it's calculated. So the labor variances, okay, and the material variances are also calculated on the same level. So the issue is not with the variable overhead. So the only thing what we understand here is the terminology which is used is different. Wherever we use it as a usage variance, quantity variance, efficiency variance under labor. Here also it will be called as efficiency. How do we write the formula for efficiency variance? What is labor efficiency variance? What is labor efficiency variance? Labor efficiency or material usage variance. It will be the difference between the usage. Usage will be in terms
Hours.
of, very good. In terms of hours. So we see that either the standard hours or the actual hours applied at the standard rate. That is how we calculate the efficiency variance. The way we calculate labor efficiency variance, we also have variable overhead efficiency variance. Standard rate per hour. So the same thing is applied here also. We have it as variable overhead efficiency variance. Variable overhead efficiency variance. Now overheads are not necessary that they are incurred only for hours. It could sometimes also be quantity. Okay. Generally we see that it can be hours. So standard hours minus actual hours. In place of standard rate, we would write standard variable overhead rate. Here it is standard labor rate. Here it is standard variable overhead rate. That is what is the difference there. So you can also make a note of it in your notebook. Standard variable overhead rate. What about expenditure variance? There we have it as the price variance. So the price variance can be presented as, what is the price variance? The difference between the standard price and the actual price applied at the actual quantity. So here also we have under the variable overhead efficiency variance. After that, expenditure variance, it will talk about the variable standard variable overhead rate minus actual variable overhead rate applied at the actual hours or actual quantity. So that is how variable overhead variances are mentioned. Coming to the fixed overhead variances. Fixed overhead variance, the difference between budgeted fixed production overhead and actual fixed overhead, production overhead. See, this doesn't vary proportionately. That is how we started this class, by understanding the meaning of what is a fixed cost. Fixed cost does not vary proportionately. It would be the same. The total amount of fixed cost would always be the same. So here we do not go ahead calculating what is the fixed overhead rate per unit, but rather our focus will be to find out what is the difference between the actual fixed cost incurred and the budgeted fixed cost, or the standard fixed cost. So the basic uh, the variance analysis involves finding out the difference between the total amount of fixed cost and the actual amount of fixed cost. But then again, that also has certain variations in the way the ratio or the formula are presented. That is what we will look into. We will take it up one by one and then see. We will see one by one what are the fixed overhead variances. The first one says the expenditure variance is the difference between budgeted fixed production overhead and the actual fixed production overhead. There is no rate per unit because it doesn't vary proportionately. So the first one under fixed overhead variance, first one expenditure variance is the difference between budgeted fixed production overhead minus actual fixed production overhead. What could be the reason for a variation? It could be maybe they were not effective to control the cost, so poor cost control, or extra administration due to changes in production methods. These are basically fixed costs. When would they change? They would not change with the changes in production, but they would change with some decisions which are taken, um, some other thing other than production. When um, the way in which the organization is managed and all, some commitments made, some decisions taken. Maybe they have decided to purchase another asset, so on that other asset additional depreciation will be incurred, so that is not subject to what is cost per unit, but that is a commitment made to purchase another asset. So it goes like that. Extra administration due to changes in the production method, new machinery increasing depreciation, uncontrollable increases in areas such as insurance. Okay, so these are the causes for increase in fixed overhead. Then, then we see under fixed overhead variances, we have volume variance, we have capacity and efficiency variance. After that, okay. First, let's start working out what are these questions about fixed overhead variance. So, while working out the questions, we will look into what is that we have to learn, and then take it forward. I hope you are able to see the Excel sheet.
Yes.
The first question on fixed overhead variance, question number 49 is there. Make a note of what the formula is. Write it. Fixed overhead volume variance is equal to the difference in volume. So, what is volume? What is volume mentioned as in this particular question? So, that is what we have to look into. We have budgeted fixed overhead cost, and they also have mentioned the activity, the volume of activity which is planned and which is actually taken place. So, there is a difference in the volume. The volume of production which they have decided is 42,500. The actual volume of production which happened is 40,000. So now there is a difference in the volume of activity. Done. This volume of activity, there is a difference, 42,500 minus 40,000. Now this variance, the variation between the two production levels should be valued at the standard fixed overhead rate. So this is similar to which variance? It is like a usage variance or an efficiency variance. Fixed overhead volume variance we have to look into as the difference between the volume which is at standard or the budgeted and which is actual, that has to be applied. So when we are writing the formula would go we have the budgeted fixed overhead cost as 170,000. So budgeted cost by budgeted quantity. That's it. The budgeted overhead rate. So here we would have it as 170,000 divided by the output is 42,500. So check that how much is the rate. 4. Simply substitute the value. We know the productions also. We have fixed overhead volume variance is equal to 4 into, in bracket, the production is 42,500 minus 40,000. Do you think this is a favorable or an adverse? Of course, it is given already adverse. Why do you think it is adverse? Why is it adverse?
Ma'am, it is because the actual cost is greater than budgeted.
Is it about the cost or is it about the volume? It's volume variance, no? It's not about the cost. It's about the volume, the activity which has taken place. They have planned to produce 42,500, but in reality, the volume of output which was produced was less than the planned ones. So they produced only 40,000. Therefore, it is adverse or unfavorable. The key point here is about the volume. It is not about the cost. Okay, so we are finding out the difference between the volume, the output, fixed output and the standard output and the actual output. Then let's take the next question. I'll get the next question, question number 50 to the Excel sheet. Okay. So 50th question, the question is saying, find out the favorable fixed overhead efficiency variance. Fixed overhead efficiency variance. So let's start. What are the details which are given? The details given are fixed overhead, budgeted fixed overhead cost, budgeted production, budgeted labor hours, actual fixed overhead cost, actual production units, actual labor hours. The fixed overhead efficiency variance. Let's start. What is fixed overhead efficiency variance? Take down the formula. What was efficiency variance focusing on? Wherever we've done efficiency. So efficiency was basically talking about, just look at this one. The formulas are not here. We'll get back to the Excel file only. Excel file we will see. See, in the previous questions when we were working out what is efficiency variance, what did we do? We have found out the difference in the hours, the standard hours and the actual hours applied at the standard rate. Okay, so the efficiency is in terms of how much was consumed, how many hours were consumed. Here also we are asked to find out about what is the efficiency variance. Efficiency variance is about how many hours were used, because we have the details given about the hours. The labor hours are given, the budgeted labor hours are given as 104,040. The actual labor hours are given as 100,000. So can we straight away start with taking 104,040 minus 100,000 applied at the standard rate? Here, one important point what we have to remember here is they have planned to produce 20,400. They have planned to produce 20,400. So according to 20,400, their labor hours also were planned to be as 104,040. But in reality, they did not produce 20,400, but they have produced only 20,000. So the plan is at 20,400. The actual is at 20,000. Are they comparable? Are they comparable? They are talking about two different levels. See, in the plan, another 400 units production details are also included, but the actual is only at 20,000. So step number one, what we have to do. See, if the output is same in both the cases, the number of units produced is same in both the cases, we can simply take the budgeted hours minus actual hours applied at the standard rate, standard budgeted rate per hour. That's simple. Efficiency variance is what is that only. So we only talk about that part of it. But now But now the efficiency variance part of it has to be little altered. Why do we have to alter? Because the production units are not same in both the situations. While planning, they have taken the output, or the plans included an output of 20,400 units. But in reality, they have produced only 20,000 units. So first thing is, we need to make them on par. Only when they are made on par, it becomes possible to compare. So what can we make? Already actually is already incurred. So what we do is, we only adjust the budget. So it makes sense, because actual is already incurred. We cannot adjust the actual. So considering the actual as the base, the standards will be altered. So here, make a note of what the formula looks like. Please make a note of it. I am also writing it on the screen. We have, I am also putting a heading here, when the budgeted output and the actual output are not equal. That is the situation. Let's write fixed overhead efficiency variance. Fixed is equal to, efficiency variance has the standard fixed overhead rate per hour. So the outside the bracket, we have the standard into the standard hours are adjusted, standard hours for actual output, minus actual hours worked. Standard hours for actual output, because they are not equal. So what should we first do is, if for producing 20,400 units, if the labor hours required are 104,040, then for the production of, just we want only 20,000. Why? Because the actual hours worked are only 20,000. So for the production of 20,000 hours, what is the number of budgeted labor hours? So that's the logic. I hope I'm clear. Okay. Okay. So we can put these details into the equation and then start. There are three variables which are to be known. One is standard fixed overhead rate per hour. Okay. So how much would be standard fixed overhead rate per hour?
Overhead costs divided by budgeted labor hours.
Okay. So how much is that?
1,248,480.
Let's 1,248,480 divided by the number of budgeted labor hours, which is 10440. Okay. Then calculate the second variable, which is standard hours for actual output. Budgeted hours or standard hours, it means the same. Standard hours per actual output would be 20,000 into 10440 divided by 20,400. $102,000. Anyway, actual hours worked is given 100,000. Substitute that. So write fixed overhead efficiency variance is equal to, rate is 12 into 102,000 minus 100,000. Why are they calling it as favorable? The question has a mention that the overhead efficiency variance is favorable. Why is it favorable? Why is it favorable? What if that term is not mentioned and we have to take a decision about defining it as favorable or unfavorable? How would we end it up?
Ma'am, the budgeted hours is more than the actual labor hours.
Okay. They have consumed less hours. So the budgeted hours allowed are 102,000, but they have consumed only 100,000 hours. So cost aspects, if they are less than the budgeted figures, then it is a favorable thing. So then on that note, it becomes a favorable variance. So this becomes, the answer is 24,000 favorable. Let's take up the next question. The following data relate to questions 51 and 52. So let's take up both of them at one go. I'm putting this data in the Excel file. A hospital uses a standard costing system to monitor the performance of its surgeons. The following information is available for June. The standard time to perform an eye operation is 2 hours. In June, the budget for eye operations showed that 320 operations would be performed and the fixed overheads attributable to eye operations would be 108,000. The actual results showed that only 300 operations were performed in a total of 660 hours and that the actual fixed overheads were 110,000. the fixed overhead capacity variance. So here the mention is about what is the fixed overhead capacity variance for June. 52nd question says that the fixed overhead efficiency variance. Okay, so first we need to understand what is capacity variance. Anyway, efficiency variance, now that you are aware of it, since you've done one question here, so the fixed overhead efficiency variance will be comparing the standard hours, the actual hours applied at the standard fixed overhead rate per hour. So efficiency part of it we will see. But what about the capacity overhead, the fixed overhead capacity variance? So that is what we have to first look into. What capacity are they talking about basically? Well, the set of information we have, standard time to perform an eye operation is 2 hours. The budget for eye operation showed that 320 operations would be performed. And the fixed overhead attributable to an eye operation would be 108,000. But how many operations were taken up? They took up 300 operations, um, were performed in a total of 660 hours, and that the actual fixed overheads were 110,000. So the same set of data we have, but the term here what is mentioned is capacity variance. So the capacity to operate, the capacity to take up the eye operations in that particular specific case. So we have to talk about what is the capacity at which they have operated. So in total, how many hours did they take? They have taken in total to operate 300 to take up 300 operations, to operate 300 I operations. The required number of hours are 660. That's the capacity at which they have worked. But what is planned? What are the number of hours which are decided as the standard? So they have mentioned that the standard time for one operation is 2 hours. So according to standards, how many hours are allowed? According to standards, how many hours should have been taken up?
600 hours.
That is for the actual number of operations. But according to the standard number of operations,
640 hours, ma'am.
640 hours. Okay. So they have the capacity to take up the activity at 640 hours. 320 hours, 320 operations into 2 hours per operation. So the capacity which is decided is at 640 hours. They have they have taken up the number of hours to the extent of 660 hours. Fine. Then we also should know what standard fixed overhead rate per hour, because the capacity is in terms of the number of hours. So budgeted hours at budgeted capacity only minus actual hours. Do you see any difference between this and, let's say, if we have to put solution number 52, and if I'm writing the efficiency variance, fixed overhead efficiency variance, fixed overhead efficiency variance, how would I write? There also we will write standard fixed overhead rate per hour in bracket. What will I write?
Standard hours according to actual
That's right.
output.
Standard hours. That's the point of difference. Standard hours or budgeted hours for actual output. Here output is number of operations minus actual hours. So the difference is in terms of whatever is planned as the number of hours, budgeted hours, we go ahead with the same number of budgeted hours. Budgeted hours happen to be as 320 into 2, but efficiency variance is very particular about comparing the budgeted hours at the actual activity level. So we need to adjust that and then only make a comparison. Okay, so let's first calculate what is standard fixed overhead rate per hour. Standard fixed overhead rate per hour is equal to what are standard fixed overhead cost, which is 108,000. See, standard and budgeted are one and the same. So I'm sometimes I'm using this term, sometimes I'm using that term. So don't get confused. How many hours? Um, Budgeted hours are so before that only let me put what are the budgeted hours, so then there will be clarity. Budgeted hours is equal to 320 into each hour, each operation requires 2 hours, so that will become 640. So this divided by 640. Substitute the values. Actual hours worked is already given 660. So calculate. The rate is 168.75 into budgeted hours are 640 minus actual hours are 660. So is it an adverse or a favorable one? This is an adverse variance 3375. So don't have to put the negative sign. So if you see that there is a negative sign, you just change the variables in the bracket. So you can put it as actual hours minus standard hours. Sign should not be put, whether it is positive, negative. Only the difference take it and then mention whether it is adverse or favorable. I think you can do now what is the fixed overhead efficiency variance. So the standard rate is there. The standard hours for actual output has to be calculated. So let's quickly calculate. The number of operations which took place are only 300. 300 into 2. So that should be 600 hours. The rest of it we know what is standard fixed overhead rate per hour, which is so when we see, I hope you got the material exam kit is there with you. Do you have the exam kit? The other day you said that you don't have it, isn't it?
Yeah,
Okay.
we don't have it.
Let's just quickly take up one last question because 5 o'clock the class ends. 53rd question. Let's take it up and then quickly put this. Variable overhead expenditure variance. So what is variable overhead expenditure variance is what we have to check that. The variable overhead variances are split into efficiency variance and expenditure variance. So efficiency variance we already have understood how many number of hours are consumed. So efficiency variance after adjusting the standard according to the actual activity also the efficiency variances are calculated. Now looking at what is the expenditure variance. So we have to understand what is the expenditure variance. The question says Trafalgar budgets to produce 10,000 units of product D12, each requiring 45 minutes of labor. Labor is charged at $20 per hour and variable overheads at $15 per labor hour. During September, 11,000 units were produced. 8,000 hours of labor were paid at a total cost of 168,000. Variable overheads in September amounted to 132,000. So